The IRS processed over 260 million tax returns last year. They flagged millions of them for review. And most of the people who got flagged had no idea they were doing anything wrong. Today, we're pulling back the curtain on exactly how the IRS catches people lying on their taxes, and what you should actually be doing to stay clean. This is not a how-to guide for cheating. This is a survival guide for anyone who files taxes and doesn't want to end up in an audit, or worse. Let's get into it. Number 1. The Discriminant Information Function Score. Every single tax return you file gets assigned a score. The IRS calls it the DIF score, and it's basically a red flag detector built into their system. It compares your return against statistical averages for people in your income bracket, your profession, and your zip code. If your numbers look weird compared to everyone else filing similarly, your score goes up. If your score goes high enough, a human auditor takes a look. The IRS doesn't need to suspect you of fraud to audit you. They just need your math to look unusual. Number 2, your 1099s and W-2s are already in their system before you even file. This is the part people don't think about. When your employer sends you a W-2, they also send a copy directly to the IRS. When a client sends you a 1099, the IRS gets one too. Freelancers, this is especially important. Every platform that pays you over $600 in a year is required to report that income. So if you made $4,000 on a freelance gig and you only report $2,000, the IRS already knows. They're not guessing. They're comparing. Number 3, cash-heavy businesses trigger automatic scrutiny. If you own a restaurant, a salon, a landscaping company, or any business where a lot of transactions happen in cash, you are in a high-attention category. The IRS knows the historical profit margins for virtually every type of business. If your reported income is dramatically lower than what they'd expect from a business your size, that's a flag. And if you're depositing just under $10,000 repeatedly to avoid bank reporting thresholds, that's called structuring, and it's a federal crime, even if the money is completely legitimate. Number 4, the home office deduction is one of the most abused deductions in the tax code. This one trips up a lot of people, especially since remote work exploded. The IRS definition of a home office is strict. It has to be a space used regularly and exclusively for business. Not your dining room table. Not the couch where you sometimes answer emails. If you're claiming a home office, it needs to be a dedicated space, and you need to be able to defend that in writing if they ask. W-2 employees cannot claim this deduction at all under current federal rules. Only self-employed people can. Number 5, large charitable deductions compared to your income raise eyebrows. The IRS knows roughly how much people at your income level typically donate to charity. If you're making $60,000 a year and claiming $20,000 in charitable deductions, that ratio stands out. Non-cash donations, like clothing, furniture, or vehicles, are especially scrutinized because people consistently overvalue what they give away. If you donated a car worth $800 and claimed $3,000, and you don't have documentation, that's a problem. Always get a written acknowledgement for any donation over $250. Number 6, cryptocurrency is not invisible to the IRS. A lot of people got into crypto thinking it was some kind of financial blind spot. It is not. The IRS requires you to report every taxable crypto transaction. That includes selling, trading one coin for another, and using crypto to buy goods or services. Major exchanges now issue 1099 forms and report to the IRS directly. And the IRS has worked with analytics firms to trace blockchain transactions. If you received crypto, sold it, or traded it, that is taxable income, and it needs to be reported. Number 7, inconsistent income across years puts you on a pattern. The IRS doesn't just look at one year in isolation. They look at trends. If you reported $80,000 for 3 years straight, and then suddenly claimed $30,000 while your lifestyle and expenses appear unchanged, that inconsistency raises questions. Same thing goes for business expenses that spike dramatically without explanation. Stable, consistent, explainable numbers are your best protection. Number 8. The biggest mistake people make is mixing personal and business expenses. This one is less about lying and more about sloppy record-keeping that looks like lying. If you're running a business and you're running personal expenses through it, even accidentally, you are creating a documentation nightmare. A legitimate business expense needs to be ordinary and necessary for your specific business. Your family vacation is not a business trip because you took one call during it. Keep separate accounts, keep receipts, and keep notes on the business purpose of every significant expense. Number 9. The IRS has whistleblower programs, and they pay out. Yes, the IRS will pay people to report tax cheats. If someone reports you and the IRS collects more than $2 million because of that tip, the whistleblower gets between 15 and 30% of what the government collects. This isn't some obscure program either. The IRS whistleblower office collected over $500 million in back taxes in a single recent year. An ex-partner, a disgruntled employee, or a former business associate can trigger a full investigation. The best defense is a clean return. Number 10. The audit itself is rarely the worst part. If you get audited and you were honest, it's annoying, but survivable. If you get audited and you weren't, the IRS can go back 3 years on a standard audit, 6 years if they suspect substantial underreporting, and there is no time limit for fraud. Civil penalties can reach 75% of what you owe. And criminal tax evasion carries up to 5 years in federal prison. The math on cheating is almost never worth it. Here's the actual takeaway from all of this. The IRS is not psychic. They're statistical. They're looking for patterns that fall outside the norm. The best thing you can do is be accurate, be consistent, keep records, and work with a qualified CPA or tax professional if your situation is anything more than straightforward. This is general information, not legal or tax advice. Consult a qualified professional for your specific situation. If this helped you understand something about how the system actually works, the subscribe button is right there. We're at Fine Print HQ, and every week we break down the legal and financial fine print that most people never read. That's the stuff they don't put in the brochure.